Well, good morning or afternoon, everybody, and welcome to today's CSPEN webinar, the latest information on the HEERF audit guide with key dignitaries from the Department of Education. Amy laughs when I say dignitaries, but we do appreciate all of our Department of Ed officials that will be joining us today and providing us with the opportunity to hear specifically about the audit guide that was presented back a couple of weeks ago and the devil of the details from the department's perspective. We'll get started here in about another 5 minutes. So everybody, as you're coming in, just welcome. I'll do the do's and don'ts reminder in another 5 minutes or so. But those of you that are on hold, just welcome, and we'll be starting in a few minutes. And guys, you can put yourself on off camera for a minute or two if you want and come back on, or like I think what Soren did, or you can stay on. It's entirely up to you. Mark, who is FCS? The Eagle or the Seahawk or whatever behind you? Come off mute.
Oh.
You're off now.
All right, there we go. That is for the Fredericksburg Christian High School my son goes to.
High school.
And
Excellent.
I coach the golf team, so he.
Oh, fantastic.
We got those for the seniors, and I had one made up for myself, and then anybody that sponsors the team, they get one that says sponsor as well. So.
That's really sharp.
Yeah. My cousin does metal art in Michigan, so he made them up for me.
Well, and I love the Laurel and Hardy behind you too, and the various different artwork.
So now I got to show so that's my son's artwork. So I
excellent.
It'd be better than a blank wall.
It's much better. And sorry to be curious, but I come by it naturally. Thomas was not just, he was the inquisitor.
Yeah.
He wasn't a doubter. He was just curious.
Mm-hmm.
And once again, welcome all of you as you're starting to join in. We'll be having the presentation start in another 4 minutes. A couple of the reminders that I'll go through once again, but I'll do it now since there's over 100 of you already in the attendance box. As always, we are videotaping this presentation, especially given the importance with the Department of Education officials joining us today, but as we do with all CSPEN. So you'll have the opportunity to review it at a later point in time on the website. We also want you to have the opportunity to offer questions and answers to the department officials. So if you, in your drop-down box, normally on the right-hand side or at the top, there is the Q&A function. I will be monitoring that. We do ask that you hold all questions until the end. You can present them as they're going through the presentation, but I'll read them off and kind of moderate the questions at the end of the presentation with all of our esteemed individuals today. We will be starting in another 3 minutes, so enjoy just a few more minutes and then we will get started. Hi, Dr. Cooper. How are you, Dr. Cooper? Dr. Cooper, can you hear me? Can you hear me, Dr. Cooper? Okay, Mark, if Amy and you and Soren want to come back online, that would be great. And are all of you able to hear me?
Yeah.
Yes.
The one I'm concerned about is Dr. Cooper. I'm not sure if she's able to hear us. Soren, can you hear me?
I can hear you.
Dr. Cooper, are you with us?
Can't get it to.
Speak again. We can hear you. Can you
Can
hear
you
us?
hear me now?
Absolutely.
Yay!
Yay!
Okay. Okay. Well, I'm just gonna hold this phone to my ear.
Oh my goodness, I'm sorry. I hate to make you do that. But we
It's
are
the
so
old-fashioned way. It's still old-fashioned way. Still works. Hey, I'll take it.
it works well, and we are so blessed to have you with us. So we thank you. It is right
My
at the top of
pleasure.
the hour. So I am going to go ahead and get started. Let me do a little bit of an intro real quick, and then I'll turn it over to you, Dr. Cooper. But first of all, thank you to the over 350 participants on today's webinar. This is, as is often the case, a very important topic for compliance with our community, and we are so blessed to have many dignitaries from the Department of Education on our call today. This presentation will cover the HEERF audit guide, the new information that was recently published at the end of March by the Department of Education, covering the HEERF compliance audit requirements for the proprietary sector of the higher education community. Important information not only for you as institutional representatives, but I know that a number of the auditors for the community are on the call, as well as other individuals. I'm going to start off by simply recognizing, as you can see, that we have 5 individuals who are joining with us today. I'm going to offer up a brief notice of recognition to Dr. Michelle Cooper, who is currently serving as the Acting Assistant Secretary for Post-Secondary Education and the Deputy Secretary for Higher Education Programs at the Department of Education. In these roles, she oversees the department's work to support and strengthen the capacity of colleges and universities to promote innovation and improvement for students and broaden the attainment of global competencies that drive the economic success and competitiveness of our nation. Dr. Cooper, we are so pleased to have you with us today. You've established a great record in working through the HEERF issues new to all of our institutions and our community. And I thank you, as well as Mark Preby, Amy Bales, Soren Lagarde, and the other individuals that I know that are listening in from the department today. So thank you, and I'll turn it over to you for some opening remarks.
Thank you. Thank you for having me. It is a pleasure to be able to join you all to say hello to everyone who's out here listening in and watching in. You will see that I am looking at you on the camera, but I am talking through the phone because my computer is having audio issues. So I'm back to using technology the old-fashioned way by just picking up the telephone. And I'm glad it works, so I can talk to you and just thank you for being here. As you know, Congress has appropriated more than $1 billion to proprietary institutions through the Higher Education Relief Funds through the 3 stimulus bills. And it is the Department of Education's desire to work very closely with you to see a positive return on taxpayers' investment. For proprietary colleges, the funds are primarily intended to help students to recover from the pandemic, including really those students, helping those students to meet their basic needs. We want to see these students persist. We want to see them complete college. And we really want to see them have the opportunity to move through this period and emerge from the pandemic even stronger than how they entered into it. So the department is working very closely with our institutional partners to ensure that there is funding transparency and compliance with all the authorized statutes. This is for institutions, all institutions, regardless of sectors. And we really want to use our oversight and compliance tools to help evaluate students' receipt of the emergency aid, assess the impact that that funding is having on key outcomes, and to make the investments very transparent to the public. And audits are simply one of the tools in our toolkit. And as many of you know, with most new grant programs are considered high risk for auditors, and this is such a case. And while many of you may be familiar with the Title IV program audit process, proprietary colleges do not typically participate in grant programs such as the ones that we're talking about today, like the Higher Ed Relief Fund or other programmatic grants. So we intend for this audit process to be very helpful to you and to your students, and will put you in a better position to monitor and mitigate any of the programmatic, financial, or implementation risks that could potentially flag. And so I just want to say thank you for being willing to do this. Thank you for all the work that you're already doing on behalf of our nation's students during this very challenging season. And I really do look forward to working with each and every one of you to help achieve our shared goals in support of students and in support of recovering after the pandemic. So I will now turn it back over to you. Thank you.
Dr. Cooper, thank you very, very much, and thank you for taking the time today. I know that you guys are all very, very busy with the transition, and now with the third set of funds coming through on HEERF as well. So I will let you get back to the many duties you cover, and thank you for lending so many of your staff to us today.
Thank you.
With that, I think I'm turning it now over to you, Mark, who will lead a little bit of a walkthrough of the very important information on the HEERF audit guide. As you can see from this slide, like I said, we have dignitaries from both the Office of the General Counsel, as well as from the Office of the Inspector General. Soren Lagarde from the General Attorney with the Office of the General Counsel. Mark Priebe, Director of the Non-Federal Audit Team with the Office of the Inspector General. And Amy Bales, also a non-federal audit team member from the Office of the Inspector General. Mark, please take it away, and I'll cover the slides.
Actually, we're gonna give it to Amy. She's gonna.
Oh, okay. Sorry, Amy. Hi, Amy. Take it away, okay. Amy.
All right. So you can go ahead into the slides then, Tom. So what we're going to cover. This is the HEERF audit guide, and as part of our responsibilities in OIG, we are responsible for developing audit guide for for-profit and foreign institutions that aren't covered by the single audit, basically. So that's what we did in this case, developed this audit guide to cover the HEERF funds that went to proprietary schools that weren't otherwise audited. As you know, the Title IV funds are audited in their own audit, but these are not Title IV funds, so they needed a separate audit. Began this process developing the audit guide. Soren was kind of my go-to with programmatic questions. Mark helped throughout the process in the review and pushing it through the review process, which is a task in and of itself. So a lot of people have had eyes on this before it got to you guys. So going through what we're going to talk about here, an overview of the HEERF funding, audit requirements and audit threshold. These are things Soren will talk to you a little bit about. Mark will go into some more detail on general audit requirements. I have the lucky job of talking to you about what is actually going to be tested. Mark and I will also talk about the audit package and submission, and along with that, Soren's going to touch on audit resolution of these audit packages once they get to the department. This is the presentation itself isn't considered official guidance from education or OIG, but it generally does reflect positions that we either an OIG or the department itself have taken in previous communications and documentation that we've issued. So I will let Soren take it from there.
Great, thank you so much, Amy. And just going over it one slide back, just a quick overview of HEERF funding. Many of you are very familiar, but as Dr. Cooper earlier said, the Congress has now appropriated $76 billion in 3 different programs for institutions of higher education, of which proprietary institutions are an important part of that. And you know, that comes into, you know, 3 different buckets. That originally with the CARES Act, proprietary institutions were eligible for both A1 institutional funds and A1 student aid portion funds, and that the Congress changed that by creating a new program in the second or HEERF2 Act, or the CRISA Act as we call it, and appropriated funds specifically for proprietary institutions, specifically to be used as emergency financial aid grants to their students, and that was continued in the most recent American Recovery Plan, or ARP Act. And so next slide, please. And so as part of that, you know, going over the audit requirement and audit threshold. So these programs now, HEERF generally spans 3 different laws and 3 different funding streams that, you know, the department came from the standpoint that nonprofit institutions and public institutions are already subject to audit requirements under the Single Audit Act amendments of 1996. And that law basically requires and sets a threshold for public institutions and nonprofit institutions to submit audits of the HEERF program through you know, a joint federal system called the Federal Audit Clearinghouse, and allows us to you know, see and hold those institutions accountable for their use of HEERF HEERF dollars. And so, as being consistent with that and wanting to make sure that we hold, you know, to all of our institutions of higher education under the HEERF program to a similar standard, the department has recently, as Amy announced, you know, put out a series of memos and information about setting an audit requirement and an audit threshold for proprietary institutions. And if we can go on to the next point, I will cover, you know, just a couple of those logistics and how we came to that. And so, you know, the big question, Brian, is that we set, similar to the single audit, that not every institution every year is going to audit the HEERF program. And so we set what we believed is a similar requirement for proprietary institutions here. And this is language taken from OIG's new audit guide that was issued just at the end of last month. And it sets that standard, that is, if an institution of higher, or a proprietary institution of higher education spends more than or expends more than $500,000 in its institutional fiscal year, or at any point during that institutional fiscal year that it had a HEERF grant, is on one of the heightened cash monitoring lists that are put out by FSA, that are a risk-based analysis of institutions in regards to the Title IV program, which is a good approximate system for us, given we don't have, many proprietary institutions do not have a lot of experience in the federal grants world. And so that requirement you can see is here on the slide. And if we could go to the next slide, I'll just break it down a little bit for institutions. And so essentially, it's 2 questions if you ask for, and this is, while specific to fiscal year 2020, it would be the same for succeeding fiscal years as well, which is, did your institution either expend more than $500,000 in HEERF grant funds, and this includes, of course, for the CARES Act funds that were received under both the student aid portion and the institutional portion together, or at any point during the fiscal year that you operated a HEERF grant, was your institution on a heightened cash monitoring list? If you answered yes, or to either or both of these questions, your institution is required to submit a fiscal year 2020 audit of your HEERF grant funds. And I'll explain just a little bit more on the next slide about, you know, trying to figure out some of the little nuances with this. And so how are we calculating this timeline? So this expenditure of $500,000 isn't just from the CARES Act portion of HEERF or just the CRISA portion of HEERF or now the forthcoming ARP portion. It's all HEERF grant fund sources together. And so if at any point you expend those funds, you have to take into account both, for instance, the institutional portion and the student portion, under the CARES Act, as well as looking at any expenditures that you may have had under CRISA or, of course, in the forthcoming in the ARP. The second point with that is the heightened cash monitoring requirement is additionally at any point during the institution's fiscal year that you operated a HEERF grant. And so, an example on the slide here is that in an institution, this would include an institution, for instance, on the March 1st, 2020 heightened cash monitoring list that received a CARES Act HEERF grant, a month or two later, say on April 28th, if that institution operated January 1st through December 31st fiscal year. And so just to be aware of that nuance and what is required there. Next slide, please. And with that, the department came to this determination. Just a couple of points with that, which is institutions, and I believe Mark and Amy will get into this more with the audit guide. But institutions are who fall into these buckets or this category to submit an audit are required to submit an audit to us by July 29th of this year. And just so you know, from a monitoring and compliance standpoint on the department side, so not the OIG side, but the department side, that we do have a list of institutions that we know who received more than $500,000 in HEERF grant funds under the CARES Act or the succeeding bills. And we will be following up with grantees that we suspect would submit an audit to us, and we may ask you to establish to the department if you don't turn in an audit, why you think you weren't covered, why you didn't have to do that. And just a reminder of just good prudent grants management for any fiscal agency, that if we do determine you were to submit an audit but failed to do so, that there could be a range of impossible enforcement actions associated with that. So if bottom line is, if in doubt, please audit your HEERF grant funds. Next slide, please. Great. I will now turn it over to Amy or Mark, I believe, to talk more about the audit guide.
All right. Thank you, Soren. So we'll go over the general audit requirements. If you can go to the next slide. All right. So the HEERF audit guide is a mixture of the Title IV audit guide and the HEERF section of the 2020 compliance supplement addendum that was issued in 2020. Most of the general audit requirements were taken from the Title IV audit guide. For example, the auditor qualifications aligned with the Yellow Book. Planning considerations required engagement letter statements, the level of internal control understanding, determining materiality, and following up on prior findings. Reporting on the engagement, the schedules and reports that are required as part of the audit package. There are some differences in the audit requirements of the Title IV audit guide versus HEERF guide, and I'll point those out as we go along. The compliance supplement requirements covered by the HEERF audit guide are the same ones included in the compliance supplement. The only difference is we had a chance to update the audit guide for CRISA, CRRSAA, and the ARP, or as we refer to as ARP, before it was issued. We also took audit objectives and procedures directly from Part 3 of the compliance supplement. If you are familiar with the compliance supplement, you know those objectives and procedures are very generic so that they can be applied to all federal programs. When inserting them into the HEERF audit guide, we were able to make them more specific to the HEERF awards. You can go to the next slide, please. All right, so as far as differences go, a major difference is the HEERF engagement is an examination level attestation. This type of engagement requires the auditor to obtain management's assertions, test for compliance with those assertions, and then express an opinion on compliance. This type of engagement requires the auditor to obtain management's assertions about compliance with the requirements specified in the audit guide, obtain evidence about the school's compliance, and express an opinion on management's assertions. Management assertions are the basis for the auditor's testing, and management should present their assertions in a letter to their auditor. The specific required assertions are found at the beginning of each compliance requirement in Chapter 2, Section C. If the school did not comply with one or more of the compliance requirements, school management must modify its assertions to disclose to the auditor the non-compliance. No, there's no prescribed sampling methodology. Instead, we ask the auditors to refer to attestation standards and AICPA sampling guidance in developing their samples. Some of the similarities are that the engagement is conducted as the eligible school level, first 6 of the OPEID, which is the same as your current Title IV audit. I'd like to point out, like I said there, that it's the same as the Title IV audit, so nothing there. This does mean that the OPIDs that expended $500,000 of the HEERF funds or are on HCM 1 and 2, or 1 or 2, sorry, are required to have an audit. I would like to point out that a company operating multiple institutions under different OPEIDs would have to look at each OPEID separately to determine if they must have a HEERF audit. All non-compliance must be reported. There is no materiality threshold. So remember, though, that you must cite federal statutes and regulations and terms and conditions of federal awards in audit findings. A guidance document is not criteria, but an auditor may use this guidance available to determine if the school is in compliance. Next slide. So now there's some, a question came through about HEERF audit versus single audit. So some of the differences which schools are subject to audit. In a single audit, OMB sets the threshold that determines when an entity is subject to audit. Currently, that is set at $750,000, but it includes all federal awards, not just HEERF funds. Which exceptions are reported as findings in a single audit? Only material non-compliance or non-compliance that results in question costs greater than $25,000 are reported as findings. In a HEERF audit is an examination level attestation engagement, and we covered that in the previous slide. Some similarities are the same compliance requirements that were subject to audit in the 2020 compliance supplement addendum for single audits are also subject to audit for proprietary schools under this audit guide. That is, activities allowed, allowable costs, earmarking, etc. They're subject to audit for not-for-profits, the same as proprietary schools. Auditors use AICPA sampling guidance in a single audit, and that's the guidance we point auditors to for the HEERF engagement. The tables you'll see in the upcoming slides are those used by the single auditors. Next slide, please. So as far as sampling is concerned, there's some items to consider when considering your sampling procedure. You may want to ask the following questions. Is my sample size large enough to reduce risk? Is my sample representative of the population? Did I treat situations where I was unable to apply my sampling procedure as non-compliance? Did I investigate the cause of identified non-compliance and evaluate its effect on the objectives of the audit? Did I evaluate the results of the sample, including sampling risk? Did sampling provide an appropriate basis for conclusions on the population, or do I need to perform additional procedures to meet the objectives? I'd like to point out that the auditor must document their sampling methodology, including size and content of population from which sample is drawn, including number of transactions and dollar values, the sampling technique used, whether it's statistical or non-statistical, the methods used to determine the sample size, and method of sample selection, whether it's haphazard, random, stratified, etc. Next slide, please. Point out, like I pointed out in the previous slide, the tables are from the AICPA audit guide, the government auditing standards, and single audits, chapter 11. The suggested minimum sample size in these tables are consistent with sample sizes provided in tables A1 and A2 of Appendix A in the audit guide. The primary determinant of the appropriate minimum sample size for a particular compliance test is the risk of material non-compliance remaining after considering audit procedures. So for example, you risk assessment, control testing, testing individually important items, substantive analytical procedures, and therefore the desired level of assurance. When auditors are determining sample sizes, auditors should consider that the guide does not require testing of internal controls to reduce control risk, but instead relies heavily on compliance testing. Therefore, the auditor may find that the higher suggested sample sizes are more appropriate for compliance testing for the HEERF audit. For small populations, the table is provided with suggested sample sizes. Your auditor is asked to sample your quarterly public reporting. So you can see from this table that the AICPA would suggest they sample 2 of the 4 quarterly postings. For populations between 52 and 250, a rule of thumb some auditors follow is to test a sample size of approximately 10% of the population. But that the size is subject to professional judgment, which would include specific engagement risk assessments, specific engagement risk assessment considerations. And now I'm going to flip it over to Amy, and she's going to talk to you about the compliance testing requirements.
Oh, the fun part. Before you can go to the next slide, Tom, thanks. Before we get into the details, I wanted to hit on a couple points of clarification. First, basics on what's covered during the audit. So for purposes of determining expenditures for the audit, lost revenue and expenditures should be reported no earlier than the date of the award or the substantial amendment to the award. So what we mean by that is the flexibilities basically that were given to you that would allow lost revenue and reimbursements. They weren't given until this year, until January and March of 2021. So they shouldn't be included as expenditures in your audit until then, until that point. That might be a little different than how the department wants you to report them in quarterly and annual reporting. And questions 7 and 8 of the lost revenue FAQs address that. But basically, there are difficulties in determining when lost revenue should be incurred. And so the department says you can do that on or after the last day of the estimation period. So that might be different than for auditing purposes when it should be included in the audit. But again, I think that questions 7 and 8 of the FAQs do a good job in describing that. So once you figured out the expenditures that are subject to audit, just know, as Thorne had pointed out, that your auditor is going to be testing any HEERF 1, 2, or 3 funds that were expended during the fiscal year. So in year 1, it's probably just HEERF 1, depending on what your fiscal year is. In year 2, it could be all 3. Another important point that your auditor will want to know is that auditor judgment is probably necessary in determining whether the required procedures are sufficient. Your auditor can't consider the guide as a safe harbor, in determining audit procedures. There is an objective that they have to meet, a stated audit objective for each compliance requirement. If the procedures don't address that objective because things have changed, they might have to address their procedures in a different way. As an example, currently the HEERF reporting compliance requirement objective is to determine if the HEERF reporting is timely, accurate, complete, and supported by documentation. If HEERF reporting changes from what's currently stated in the audit guide, then the audit procedures that are stated might not be appropriate to get you where you need to go to be able to express an opinion on that specific objective. So just keep that in mind for your auditor. If your auditor comes back to you in year 2 asking for different things than they did in year 1, that could be a reason. And then the last thing I wanted to touch on here is uniform guidance changes that were effective, issued last year and effective for awards issued after November 12, 2020. So your CARES Act award before that would likely be subject to the old uniform guidance requirements. And I'll talk about those as I get to those sections, but generally it was procurement standards and closeout provisions that were affected by the uniform guidance changes. Okay, you can go to the next slide then. We'll jump into activities allowed or unallowed. And what I mean by that is basically was HEERF used only for allowable activities. The award tells you what you can and cannot use these funds for. In general, CARES Act allowed a broad use of funds, and then CRRSA came along and allowed an even broader use of funds, an expanded use of funds, what they call it, that allowed for defraying expenses associated with the coronavirus, including lost revenue. And that, again, I would direct you to the FAQs on lost revenue for additional details. Reimbursement for expenses already incurred, technology costs, et cetera, along with carrying out student support activities and making financial aid grants to students. That's what's allowed. There's also specific things that are not allowed. Institutional funds can't be used for funding contractors for provision of certain activities, can't be used for cash or benefits for senior administrator or executives, and student portion funds can't be used for reimbursements for costs, refunds, other benefits previously issued to students, only direct payments to students. So when your auditor is testing this, you're going to pull a sample of transactions based on the sampling methodology that Mark described and what's suggested by the AICPA. They're going to look that the charge was for an allowable activity and was not for an unallowable activity. They're going to look at your distribution plan for the funds and make sure there's no inappropriate restrictions, meaning no restrictions that go beyond what's in the statute, and looking to see that your HEERF 1 student portion and all HEERF 2 and 3 went towards these emergency grants to students. All right, moving on to allowable costs and cost principles. So this question is, were charges to the HEERF grant allowable, and were indirect charges appropriate? So there are basic guidelines and cost principles. They say, like, charges must be reasonable and necessary. Allowable cost items, they have to be treated consistently and they have to be documented. These are all basic requirements that apply to all cost items for all entities. And then you go into 200 to CFR 200.420 through 475. These are specific cost items that are addressed in uniform guidance. Some are applicable to all entities, some are specific to the type of entity. For example, an institution of higher education can never never have cost items for alcoholic beverages, alumni activities, bad debts, lobbying, that sort of thing. So you would look there for the specific type of cost items. And then some items of cost require prior approval from the department. The department did, due to the pandemic, give a sort of blanket approval for certain items of cost, equipment, some compensation, pre-award costs, travel costs. That is all covered in the A4 FAQs. So see that for more detail on the prior approval that was provided. And then moving to indirect costs, if it is reasonable administrative costs or indirect costs, it can be charged to the institutional portion, but not to the student portion. Those are, again, only direct grants to students. So if a school has never had an indirect cost rate agreement, they could elect to charge a de minimis rate of 10% of modified total direct costs. Getting into the audit procedures for this, your auditor is again pulling a sample of transactions, and it could be the same sample from activities allowed or unallowed, or they might decide that they need a separate sample. But either way, they've got a sample, they're testing to confirm that they meet these basic requirements and any requirements that are specific to institutions, and then they're looking at indirect costs. The procedures are a bit different based on whether you have an approved indirect cost rate or if you're using the de minimis rate, but basically they're deciding if you've used an appropriate rate and applied it to the correct base amount. And then, so they're looking for your indirect cost rate agreement if you have one. or if you use the de minimis, they're confirming that you did not have one previously, and they are directed to go look back for 3 years. We don't have them look back indefinitely, but for 3 years, they'll be looking for evidence of any agreement that you had on indirect costs. All right, moving on to earmarking is the next one. This is the question: was no less than 50% of your HEERF 1 funds used to provide the emergency financial aid grants to students? This 50% division was made by the Department of Education, and it was into the student aid portion, the 84-425E, and the institutional portion, which was 425F. So when we say at least 50% of the funds should be used for the financial aid grants to students, that is generally going to be your student aid portion award. So testing of this requirement would only be done at the end of the period of performance, or if you expended, your entire portion before the end of the period of performance, your auditor could check for it then. It has to be met by the end of the HEERF 1 period of performance, even if you use the expanded use of funds authority under CRRSA for unspent CARES Act funds. So just keep that in mind. All right, moving on then to period of performance. So was your HEERF grant charged only during the period of performance, or is otherwise authorized? So you have the 1 year from the date of your award for HEERF 1 and HEERF 2. Then the HEERF 3, when those come out, are to supplement HEERF 2, which means it would extend the period of performance of HEERF 2 funds by a year from when you got the HEERF 3 award. So keep that in mind. Ed had originally taken the position that obligations under CRRSA needed to have been incurred on or after December 27th, 2020, which was the date of that act, but in March issued a notice of interpretation allowing schools to charge pre-award costs back to March 13th, 2020. So the procedures that your auditor is going to be performing when your period of performance is during the audit period. Your auditor is looking at the transactions for costs that were recorded during the beginning portion of the calendar year to verify that they weren't incurred prior to the start of the calendar year or prior to that March 13th, 2020 date. And then when your period of performance end date is during your audit period, this is likely year 2, your auditor will look at transactions during the latter part or at the end or after your calendar year to verify that those costs were incurred within that calendar year unless you got a no-cost extension from education. So they're going to also test transactions that were not liquidated, meaning that they didn't have a payment made as of the end date to verify that those payments were made within 90 days. This is a change in uniform guidance. Uniform guidance changed the time for recipients to liquidate financial obligations from 90 to 120 days. And I just wanted to real quickly let Soren talk a bit about Ed's plans for that.
Thank you, Amy. And just to be really clear, our plans are yet forthcoming, but we are in the process of extending that liquidation period from 90 days to 120 days for all of our grants, including those grants that were made before these latest changes to the uniform guidance went into effect this past November. And so grantees who received a CARES Act award will have that 120 days for their liquidation. Back to you, Amy.
Breaking news. Thank you. So also your auditor is looking at adjustments or any manual journal entries, just again, making sure that they fall within that period of performance. All right, that's all for that one. Procurement, suspension, and debarment. Schools need to have procurement procedures for the acquisition of property and services under federal awards. They might not have had these procedures before because probably all they were receiving was Title IV, which did not require them to acquire any products or services. But you do have to have these procedures now, and they have to comply with uniform guidance requirements, which tell you how transactions have to be conducted in a full and open competition. They tell you the method of procurement that you have to use and the different thresholds that transactions would fall into. So there are these thresholds, these established dollar thresholds that were updated in 2018 that schools should adopt before they're formally codified in the federal acquisition regulations. But basically, micro purchases are those under the micro purchase threshold, which is at $10,000. Those transactions can be awarded without solicited competitive quotes if the price is reasonable. Uniform guidance change permitted increase in micro purchase threshold up to $50,000 if the justification was documented. After that, you have small purchases, which are above that $10,000 threshold, but below the simplified acquisition threshold, which is established by the school, but it can't be more than $250,000. Those have to obtain price or rate quotes from an adequate number of qualified sources. And then you have oversimplified acquisition threshold. You have to perform a cost or price analysis using sealed bid, competitive proposals, or non-competitive proposals as allowed by uniform guidance. One of the circumstances that would allow you to use non-competitive is a public emergency like the pandemic. So if you rely on this exception to do sole source awards, you really have to document your justification for that, and your auditor will be looking at it. The farther removed you are from that March 13th, 2020 date, the less likely it is appropriate to use this exception. So keep that in mind. The auditor's procedures, they're looking at a sample of procurements and determining if the proper procurement method was used based on the dollar amount. Verify that there's a history of the procurement, including the rationale for the method used, selection of contract type, basis for contractor selection, that kind of information. That's the procurement piece of this. Suspension and debarment means when you enter into a covered transaction, which is defined as contracts for goods or services of $25,000 with an entity, you have to verify that that entity is not suspended or debarred or otherwise excluded from participating in that kind of transaction. So to do that, you can check SAM, you can get a certification from the contractor, or you can put it into your contract that they are not suspended or debarred. Your auditor is going to look that you have procedures that address this and that you followed your procedures for any covered transactions. Moving on to the last bit, which is reporting. Basically, as I mentioned earlier, the objective is to figure out if the required reports were complete, accurate, timely, and supported by records. So, as it currently stands, there are 3 components to reporting for proprietary schools. You have the quarterly public reporting on the A1 student portion. That's the 7 reporting elements in an initial report that was due no later than 30 days after the award, 45 days thereafter, until October, when they were supposed to be posted within 10 days of every calendar quarter. You have the quarterly public reporting on the institutional portion, which is done through an ed-developed form where you identify specific amounts spent in each of the categories. That again is posted within 10 days of every calendar quarter starting in October, but that one was due on the 30th. And then you have the annual report, which is a HEERF data collection form that collects information on how you used your HEERF. First one was due February 8th, I believe, 21, covering March through December 20. Future annual reports right now are going to be due in February and will cover the previous calendar year. So the test in here is, first, they're testing that there was evidence of the appropriate number of quarterly public postings. And this, we got some questions on this from the auditor community and the schools about how that might be established. And so the department tried to address that at the end of the audit letter that was posted early in March. And I'll just let Soren touch on that real quick.
Thanks, Amy. And yeah, like Amy was saying, at the end of that March, I think March 7th letter that is available on our, CARES Act and CRISA HEERF websites, we, address some flexibilities that auditors would have in looking at that we're not looking for exact, precise screenshots of emails sent, for instance, but we are looking for an overall general compliance picture that, if an institution was required to post this information publicly and make it, for transparency and accountability, that we would like to see that the institution, made that effort on or about the same, approximately the timelines that have been laid out in our various reporting documents. And so please refer to that question when trying to assess compliance with this particular requirement. Thanks.
Okay, and then so that was timeliness, but there's also testing for accuracy and completeness, making sure that all elements are included and traced back to support, that the data is summarized correctly, it's mathematically accurate. If you identify unexpected differences, you investigate the reasons and determine that that's reasonable, and that the reported student distribution method matches what was actually employed. When the audit guide identifies key line items, which it does, your auditor should focus their attention on those key line items. And then your auditor will also be asking for representations from you as to what you provided them to audit as far as these public quarterly postings. And that is important because of what we talked about. It could be hard to identify exactly what was posted at one time when those posts are replaced by the most current public reporting. So your auditor is going to ask you to certify in a representation to them that what you're providing them is truly what was posted. The department hasn't yet established reporting requirements for CRISA and ARP, but those will be communicated to you when and if they are established. And then I believe that's it. We talked about all the compliance requirements. So I'm going to turn it back over to Mark to talk about the audit package and what it's going to look like once your audit is complete.
Thank you, Amy. So for me to talk briefly about the audit package and submission, you can go ahead and go to the next slide there. So this is all laid out in the guide, obviously, but we'll just touch on them real quick. That the first item that would need to be in your report package is the information sheet, and this provides information about the school and the auditor. The form and recorded content of the information sheet are in D.6-1. Then you'll also need a report on management's assertions on compliance. This is the auditor's report, the school assertion about compliance with the specified requirements of the HEERF grant program. This report is where the auditor must report findings of non-compliance, significant deficiencies, and material weaknesses. This report should be on formal letterhead representing the independent auditor's firm. When engaged to report on an assertion and the auditor identifies material non-compliance, the auditor should report directly on the subject matter rather than on the assertions. This is illustrated in D.6-3C within the audit guide. Schedule of findings and question cost. A schedule of findings and question cost must be included as part of every HEERF audit package. The schedule of findings and question cost includes information about the amount of HEERF grant funds expended during the fiscal year, and it identifies all your findings of non-compliance, significant deficiencies and material weaknesses identified during the compliance attestation engagement. If there were no findings, the schedule should include a statement to that effect. And then there's the summary schedule of prior findings. For fiscal years subsequent to the first fiscal year during which a school expends HEERF award funds, the school must prepare a summary schedule of prior findings to be submitted with the HEERF audit package. In the schedule, the school should report the status of findings reported in audits, attestation engagements, program reviews, or other studies that directly relate to the school's compliance with the HEERF grant program. Program requirements in this guide that were issued to the in the prior fiscal year or during or after the audit attestation period, but before the date of your report. Findings reported in the prior year's summary schedule of prior findings as unresolved. This can be found in the illustrated section of the audit guide D.6-3. This is different from the Title IV audit because in that guide, the prior finding schedule is an auditor responsibility. In this guide, it is the school's responsibility to report the status of their prior findings. This is more in alignment with the prior finding schedule in a single audit. And then last but not least, the corrective action plan. When the compliance attestation engagement contains findings, the school must prepare and submit with the reporting package a corrective action plan to address each finding included in the schedule of findings and question cost. This is illustrated in D.6-5. You can go to the next slide. On the report due dates, for fiscal years 4/30/2020 through 12/31/2020, we must play catch up. Therefore, they will be due 120 days from issuance or July 29th, 2021. No, that's not a typo. We didn't forget that there's 31 days in July. That is, in fact, 120 days from March 31st. So they will be due. And that was communicated in the transmittal letter that was posted with the audit guide and is on our website. And currently at this point, there is no discussions within ED on extending the 120-day due date. You can go to the next slide. And I'm going to flip it back to Amy. She's going to talk to you about how you get this report to us.
Hopefully very easily, but we tried to make it as easy as possible. Ideally, you would submit this with your Title IV audit, right? In Easy Audit. You would go through the process to upload your Title IV audit. You would answer all the questions there, and you would just attach this as an other file type in the upload attachments, right? So there's, you upload something, you identify whether it's financial statement or compliance or corrective action plan or other. This would be other, and you would just attach it there, and that's how the department gets it. However, some of you have already submitted your Title IV audit for the fiscal year that you also had HEERF funds in. So when that is the case, and that's going to be for the first year HEERF audit, you are going to follow the process identified in the Easy Audit step-by-step guide for submitting a stub audit. Usually that would be used if you changed your fiscal year, but this time it's used for the HEERF audit. So when it asks you for a reason why you're submitting a HEERF audit, or why you're submitting a stub audit, you're going to say that it's for the HEERF audit package, and that instruction is in the audit guide. We've told you which kind of screen to identify that it's the HEERF audit guide that you're submitting. And then just know when you're going through that process, there's a completeness checklist, but that is listing the Title IV audit requirement checklist. And the reports and schedules that are required for the HEERF audit are similar, but not the exact same as what is required for Title IV. So kind of ignore that checklist and look to the audit guide to confirm that what you're submitting includes everything that needs to be there. Again, that step-by-step guide for Easy Audit submissions is right on the Easy Audit website. The front page there, or it's also linked to directly in our audit guide. I'll turn it back over to Soren to talk a little bit about audit resolution once the department gets these audits.
Great, thank you. Next slide, please. Yes, so as Amy said, audits are uploaded by grantees, proprietary institutions, to the Easy Audit system. And then what happens with them? What do we do? So audits will now go, instead of, Easy Audit is a FSA system, they will instead be directed with audits with findings to our Office of Financial Operations, who has a team of program managers who will work to resolve these audits. Those audits, they will work internally within the department with the Office of Post-Secondary Education, OPE, and of course the Office of General Counsel, OGC, where I am. And for resolution processes, OFO will, for those audits that do have findings, OFO will be the people who work there will be your main point of contact for resolving any findings. Next slide, please. And finally, I think that may be a near close here for us. We just wanted to take a minute to put out some specific reminders or reminders or there you go for the HEERF grant program. So for those folks who are going to be closing out their CARES Act grants, please contact your program officer who is indicated on your grant award notification or your GAN with any closeout questions and regards to those procedures. Just to note that our quarterly reporting requirements still apply for CARES Act grants. And for proprietary folks, we've received several hundred applications for the A4 program that CRISA put out in early January. Unfortunately, Congress prescribed a 90-day timeline for funding applications under that program. And so if you are interested in, if you haven't yet applied and haven't yet received funds for your students, that timeline is rapidly closing. We are required to receive completed and correct applications by Thursday, April 15th. 11:59:59, stroke of midnight. And that link there, and I'm sure Tom can send it out too, is the link to the webpage where you can get more information about that. And of course, Congress has, last month appropriated a bunch of new funding for the HEERF ARP program, and we'll have announcements forthcoming about the program in the next few weeks. And so that's all I have. Tom or Mark, or who to close it out here?
I'll just point out real quick that if you have audit related, and there's still going to be about 30 minutes to go through some questions that Tom will administer here, but I just wanted to point out that if there's any audit related questions, you can email the OIG non-federal audit email box, and we'll do our best to get you an answer on audit related questions. If there's any program or policy questions, you can email the HEERF@ed.gov email box, and they'll do the same and get back to you as best they can. Understand that there's a lot of questions coming in, and it might not be immediate, but we'll do our best to get back to you as soon as we can. I'll turn it over to Tom to go through any questions that were received through the chat.
Well, first of all, thank you one and all. I hope you can see on the screen the thank you with the applause that comes from all of the over 350 people that are in attendance on today's webinar. Thank you so much for all of the presentation and the materials. Some of it a little hard to swallow, and I've got a couple questions myself on uniform guidance and how we're supposed to adapt to something we've never done before, but we'll get through that too, like we get through so many other things. I do want to start off with one question, Soren, probably most directed at you, but for the whole team. There are some schools, you brought up in your closing slide, the fact that the April 15th deadline is certainly upon us. I know that you, Karen Epps, and so many others of the team have been working so diligently on those applications that have come through. You do have some schools that feel that they're on the other side, where they've submitted everything and they're waiting to hear back from the department officials and haven't heard anything. And as you might imagine, they're getting anxious. Is there anything that they can be doing, given the fact that you said by the stroke of midnight, the application has to be completed, if they haven't heard anything more from the department recently? I hate to put you on the spot, Soren, but they're anxious on their side too.
Well, Tom, thank you for that question. I completely understand it, and know that if your application is turned in and it's complete, and that's done before midnight on April 15th, then assuming it's complete and assuming there's no problems, if we take a few more days to obligate that beyond April 15th, that's no problem. That if they haven't received an award by April 15th, that doesn't mean that there was something necessarily that there was something wrong, or that they weren't eligible, or that there's a problem. But those folks, Karen, as you mentioned, and all of the OPE HEERF team is working really hard. And if you have submitted your application, perhaps with some time that has passed and you haven't heard anything, Mark had put up in the previous slide the HEERF@ed.email box. We do encourage folks to reach out to us through that box, and we'll try to get back to you. But yeah, we do, but as we said, we're working hard. If you haven't gotten those applications in, the important thing is to get it in before midnight on April 15th.
Yeah, and they definitely have them in. We just want to make sure that there's some of them, as you know, that we're in various stations of requesting information back from the regionals and back from you guys. And again, just wanted to make sure, because several questions were coming up, as you might imagine, on that particular issue. I will go directly to some of the questions that we had. First of all, many people thanked you all for your presentation, so I will do that yet again on their behalf. One of the first questions was, does the $500,000 threshold include student and institutional funds, and does it cover HEERF 1 and HEERF 2 expenditures? Amy, I think you covered a lot of that stuff, but for the group, the direct question was with regard to the initial limit on the audits, on determination of audits at $500,000. Can you go back a little bit and remind them of HEERF 1 and HEERF 2 expenditures inclusion, and or the fact that it does, I believe, include obviously both student and institutional funds?
That's right. It does include both student and institutional funds, and HEERF 1, 2, or 3, whatever you got or whatever you expended during the fiscal year. It does not, of course, include Title IV, but it does include any HEERF funds.
If a student has more than one OPEID number, is the $500,000 threshold by OPE or cumulatively for the school group? I believe you said before that it's by OPE number, but I just wanted to make sure.
Yeah, I mentioned that it was by OPEID, and that the auditor or the school should review HEERF expenditures by OPEID to determine which ones of the OPEIDs qualify or need to have the HEERF audit done.
Thank you. If a school drew down all of its HEERF funds instead of waiting until they were ready to expend, and the funds are in a separate account and the funds drawn exceed 500K, but the funds expended are less than 500K, should the school have an audit? Does the school have an audit?
No, not if they expended less than 500,000. However, you might get an inquiry from the department saying, we saw that you drew down more than 500,000. Show us, or tell us why you didn't meet the audit requirement. You would respond saying, this is our calculated expenditures for the fiscal year. And lucky for you, cash management drawdowns is not tested in this audit.
But that institution would still be required to meet the $500 or more interest requirement and submit that money back to the federal government if their interest accrual is over the $500 limit. See, right? Did I get that one right?
Yeah. Oh, great. I was just gonna make a plug for that. Part of that proper cash management of grants is we don't, we want to minimize that time between you drawing down your funds from G5 and then, paying the bills or expending your funds. Is it suggested in the audit guide that we can have the audit submitted with our annual compliance audit? Is this in fact true, or must we have the audit submitted on 7/29? Again, you covered this, Amy, in terms of the timelines for the stub audit as well as the regular one, but could you refresh that one again, please?
Right. Basically, if you haven't submitted your Title IV audit, it hasn't been due, you haven't submitted it, yes, the department would like you to submit it with your Title IV audit just as a separate attachment, as an other attachment. If you've already submitted, then go ahead and use the stub audit process that's explained in the guide.
Respectfully, given that every institution, public, nonprofit, and for-profit, is equally capable of properly or improperly expending HEERF funds, why does OIG consider proprietary institutions higher risk and thus require us to have a special audit requirement? Sorry for the tough question, but I promised that I would give the questions as they're asked.
No, I appreciate that. I can speak for the department that, as I said in some of my remarks, that really what we're doing here is proprietary institutions and for-profit grantees in the federal government generally don't have by default come into something called the Single Audit Amendments Act of 1996 that creates a whole audit requirement and ecosystem for our grantees. And so what we were doing here is not singling out proprietary institutions are. We were merely bringing them into the fold in the same way that we already have audit requirements for all of our public and private nonprofit institutions in the HEERF program.
Thank you for that, Soren. Confused
I
with
would
the.
just add that, I'm
Go ahead,
sorry.
Amy.
I
No, go
would
ahead,
just
Amy.
add that you would, if you're familiar with the Title IV Audit Guide and the Title IV requirements, this guide is pretty different in that there's not a lot of overlap. These are completely different type of funds and require you to have different procedures and to be in compliance with uniform guidance, which you don't have to do in the Title IV program. So that was a consideration that we wanted to make sure that these funds specifically, and not just the school's overall processes, were subject to audit as they are for not-for-profits and public institutions.
And for the community on this call, one of the other important things to remember, whether or not we're having challenges with going through this new process, because these are, as the department has said on multiple occasions and in multiple ways, non-Title IV funds, that actually works to our benefit when we consider things like the 90-10 calculation and the fact that given the fact that all of this is outside of those requirements, I think that even some of our biggest critics would have a hard time suggesting that these funds should be part of 90-10, given how much the department has shown that these are outside of the parameters of normal Title IV. That was my soapbox. Guys, you don't respond to all of that, please. Did they state that nonprofit organizations will use the same audit guide and standards that they are reviewing today? Just wanted to confirm.
Not the same audit guide, but the same compliance requirements are subject to audit. So as I was talking about activities allowed, allowable costs, earmarking, all of those same things are subject to audit for not-for-profits and public institutions through the compliance supplement. And we took the procedures directly from the compliance supplement, just made them specific to HEERF where they are written so broadly in the compliance supplement. We were able to make them specific to HEERF.
Thank you for that, Amy. A little bit confused by the July 1 compliance audit submission deadline. Per the HEERF audit guide for our institutions, it states that the latter of 120 days after the date of the issuance of the HEERF audit guide or after the date of compliance of Title IV report is due. Could you please clarify? I think you did this one before, but again, since we're getting several questions, if Amy, you could go through once again and maybe I'll even go back to that slide for a minute. If we can talk again just for a minute or two about specifically the submission of Easy Audit and Title IV audits versus the stub audit. And I went back to that slide because we've gotten multiple questions on that one. It's new to everybody. So if you could go through that one more time, I think it might be advantageous.
Sure. So first, let's talk as if we were already past year one, which is kind of confusing. If we're in year two, you're going to follow the process to get your Title IV audit and your HEERF audit probably done at the same time, maybe even by the same auditor. And then you're just going to submit it as a separate attachment in Easy Audit with your Title IV audit. Fine and dandy. If the department were to give you an extension for your Title IV audit, you would follow that for HEERF audit as well, right? Now we talk about year one where things are weird because you might, depending on your fiscal year, have already submitted your Title IV audit. And that's why we had used the language the later of when your Title IV audit is due or 120 days. So if your Title IV audit has already been due, then you have to meet this 120 days requirements when we're playing catch up on those 2020 fiscal year ends that had HEERF expenditures over $500,000. And so if you've already submitted your Title IV audit, you have to get it to the department in another way, and that way that we've discussed with them is to use the stub audit process within Easy Audit. Hopefully that's clear.
Thank you. I hope it helps as it goes through as well. Oops, hold on, back one. We are on the cusp of the population of 250 students, depending on the time of year. Would the population be as of the date of the audit? So again, we're getting into the sampling sizes and what some of that information would entail.
Okay, so on the sample, the procedures in the guide don't require, generally, where the procedures require a sample, it's a sample of transactions. So that's a sample of your, cost charged to HEERF. There isn't, this eligibility is not something that is tested in the HEERF audit. So there's not a sample of students where your auditor is testing the eligibility. So we're not looking at your student population.
Good to know. Ed has indicated lost revenue is allowed to be claimed along with using remaining HEERF 1 grants for students. A student accounts receivable, March 13th to 2021 guidance. However, 2 CFR 200-426 indicates bad debts are not allowed. It seems contradictory that bad debts are not allowed if lost revenue is using institutional funds for AR are allowed. Any insight? You can tell that one came from a CPA.
Sure, this is Soren. I can take that one. So it does depend on the nature of the lost revenue, right? So if the lost revenue is a student, has a outstanding account balance, the definition of bad debts in 426, it isn't. It is, I believe it's an unrecoverable debt. But I do think that this is an area where we can, perhaps be more, provide more clarity going forward. I don't know if Mark or Amy have anything with
that. Questions about the HEERF 2 deadline again, and then the fact that, yes, in fact, the HEERF 2 deadline under Carissa is in fact on 2 days from now, and that institutions have the opportunity to have completed the forms to do so. I will send additional information to 1 or 2 schools that asked for additional follow-up. I will remind you that the HEERF@ed.gov is the best place to submit your questions to, as was on the prior slide. Here, let me go back to that one so that you have.
Certainly, and with that, Tom, the process for applying for an A4 grant is the submission of the certification and agreement and a few other items. And
you have to go through the G5 system, and we've done, and you guys know that we've done multiple presentations throughout the months of February and March, including pulling directly from the Department of Ed's side. You guys did a step-by-step process of how to go through the G5. We literally took all of your screenshots and shared that with all the institutions and others. So that's where I'll refresh some of these individuals to go back to in obviously short order to remember some of what we've already put forward. We have flagged institutional expenditures that meet the requirement to be HEERF eligible. The total well exceeds our allocation. If any expenditures would be challenged for some reason, would that matter if the total HEERF allowable expenditures exceeded the allocation? In other words, if your HEERF allowable expenses exceed the allocation, wouldn't that be all that ultimately matters? This probably is a very common scenario, but may not have been considered. You want me to read that one more time? I'm sorry for my phone going off. We have flagged institutional expenditures that meet the requirement to be HEERF eligible. The total well exceeds our allocation. If any expenditures would be challenged for some reason, would that matter if the total HEERF allowable expenditures exceed the allocation? In other words, if your HEERF allowable expenses exceeded the allocation, wouldn't that be all that ultimately matters? This probably is a common scenario, but may not have been considered. I think what they're trying to say is, obviously, for many institutions, especially since we only have institutional HEERF 1 funds, the amount of potential utilizations for those funds could far exceed their amount of actual funds provided. But you're still going to assess them on what they utilize those funds for, correct?
Correct.
Yeah, I'll send this question to you so you can look at it a little bit further, but I think that's what they're trying to get to. If I didn't properly address that one, send me another one. You know who you are that sent that, so I can try and reiterate the question maybe a little bit more directly. What about institutions with a 6/30 fiscal year end date? Our fiscal year ends on 6/30/20 and was already audited. Is that fiscal year still applicable for this new HEERF audit?
Yes, any fiscal year in which you expended funds, even if you're already done with your Title IV audit. That's
and
where the
again,
sub-audit
you must meet there are the benchmarks in order to be required to fulfill the audit requirements. But if you meet those benchmarks, then you have until July 29th of this year in order to submit that first audit. Correct, Amy? That's trying to make it as simplistic as possible.
Correct.
Yeah, as long as they expended the 500,000 and or were on that HCM 1 or HCM 2.
Correct. Those are the two thresholds that you guys started the entire presentation with. What about institute? Does the $500,000 HEERF funding threshold that triggers the audit require only apply to institutions that kept funding, or does it also apply to institutions that gave 100% of all funding, including their institutional portions, to students? We are not on HCM 1 or HCM 2, so we do not meet that threshold. But if we are above $500,000 and used all of our money for students, are we still under the audit requirements? I believe the answer to that is yes, because you've exceeded the $500,000 threshold.
Right.
Again, another one, if we already submitted our audit for fiscal year 20, is the deadline still 7/29? We've answered that. As a non-Title IV institution, is there any way that I am eligible to receive either CARES or CARISA funds? I believe, unfortunately, the answer to that is no, because Congress set the limits around Title IV institutions. But guys, am I wrong?
No, that's correct. But there was a new program created in CARISA and ARP that separated out proprietary institutions under the A4 provision.
And those still must, but the basic thresholds, Soren, are still that you must be a Title IV eligible institution to apply for the CARISA funds, correct?
You have to be an institution defined under the HEA Section 102B to be
right,
eligible
which
to
is
apply for funds, or an institution defined under 101 HEA 101 to be eligible as a nonprofit or a public institution, and
right.
be eligible for.
So unfortunately, even though the CARISA did expand it to include eligibility for students that were in Title IV, non-Title IV programs, it's not a non-Title IV institution that can apply for those funds. They still have to be Section 102B of the HEA, which is a Title IV eligible participant. If the entity has a year end of 12/31/20, does the due date of the submission of the HEERF compliance audit report still July 29th of 2021, or 120 days after June 30th, 2021, which is the submission deadline for our Title IV audit?
So on the 12/31/20 year end, they would have qualified for the 6-month extension that came out in the HEROES Act. So in that case, then we would expect the HEERF audit to be submitted with that Title IV audit on 6/30/2021.
Well, sorry, I don't want. Wasn't it the extension only to fiscal year is ending 6/30/20, meaning due 12/31/20?
It was anything due by 12/31/20.
So that would be a fiscal year end 6/30/20.
I would assume due word, yeah.
If you were a 6/30/20, your Title IV audit was going to be due, I guess, 6/30/21. If you're a 12/31/20, your audit is still due 6/30/21, and your HEERF audit is due July 29th.
By 29th.
Yeah. So you get that extra almost month.
But they can submit it together. So.
But yeah, I was about to say, but they are allowed to submit them together. That was another question that we got.
Yes.
We are a very small nonprofit private school. Even we included the HEERF, even though we included the HEERF 1 funds, we are below the $750,000 threshold during the audit calendar year of 2020. We were approved for the exemption waiver from Easy Audit. I know HEERF is part of the Easy Audit. Do we need to do a HEERF audit? Thank you. Keep in mind, this is a private nonprofit as opposed to a private proprietary school.
If this is a private nonprofit school, they're subject to the requirements of the Single Audit Act, and their audit submission procedures, their what to audit and what thresholds they meet are all governed by those requirements. And they would
The single audit requirements, correct, Soren?
Right. Their audit goes to something called the Federal Audit Clearinghouse, not through for HEERF. It would go through the Single Audit Clearinghouse, not through Easy Audit.
Soren, I think this one is for you, and it's a question we've had on several other ones, but still continues to perpetuate itself. My college has issued fiscal checks to students. A small handful of those have still not been cashed. We attempted to contact the students to cash them. We are approaching our 1-year deadline for the conclusion of the CARES Act funds. We have spent them, but still have these outstanding checks. What should we do about these funds? Would this be something that is audited, and how do we respond?
It's a great question. We are working on more guidance. That question is being considered. So I'll leave it to, we'll respond as soon as we can.
Thank you. There's not yet compliance guidance for institutions that share the cost such as legal and accounting and consulting being COVID related. What is the auditor to do without complete guidance? I'll read that to you one more time. There's not yet complete guidance for institutional share of costs such as legal, accounting, and consulting being COVID related. What are the auditors to do without this guidance? I think again, under the institutional portion, and I do think you guys have covered this previously, especially when it comes to CARES Act funds, under the institutional portion, are they allowed to use that to cover the cost of these audits or of these various aspects that are COVID related? Their legal guidance, the actual auditors, actual audit of the money, or other guidance that are information they need.
So I caution to, of course, begin with the uniform guidance, which discusses under subpart E on all related costs. Your question, you mentioned legal costs. There are some restrictions on using grant funds for lawyers like myself. But of course, but to your point, Tom, yes, if you have remaining A1 institutional CARES Act funds, you can take a reasonable proportion of those remaining funds and pay for your HEERF audit.
Under the grant administrations, under the FAQ, question 10 talks about do the existing CARES Act funds, Act HEERF FAQs still apply? That was back on when you updated things. There is a question as to whether or not the attestation is still required to document COVID-related impact. In other words, under CARISA and under the new HEERF 2 and HEERF 3, you were required under HEERF 1 to have an actual student attestation that the funds were related to COVID. As we've moved into CARISA and HEERF 2 and now HEERF 3, is that attestation still required by students?
So that's not exact. We're working at, I think the question began with the premise of question 10 in the original FAQs that we issued in January about going through our FAQs and figuring out what applies and what doesn't, now that Congress has issued 2 different relief bills subsequently, and that policies have changed. We'll get back. Thank you. Please flag this question. We'll get back to them.
Yeah, and it's an important one. We recognize and understand that most certainly, if you're looking at providing some of the HEERF 2 and or HEERF 3 money to students, that will come back to the institution, that we have to have the corresponding information that shows that there was no coercion or anything else, and the student is choosing free will to obligate those monies. But the attestation was a separate part of the HEERF 1, and I guess schools are now asking, is that a carryover or not as well? So guidance that you can provide there would be grateful, or would be helpful, and obviously something that we would hope that you can provide.
Happy to take it back.
Thank you very much. Did I hear that we need to pay back the interest earned on funds sitting in the separate bank accounts? Where can I find out how to do that?
Sure. Our website has a link to procedures that you need. If the institution received a A4 grant, so under CRISA, under 84425Q, that certification and agreement that you completed as a condition and filled out in order to get those funds had instructions for returning more than $500 in accrued interest, all federal grants together. And those instructions are hyperlinked, and we can send them. If you don't have them, Tom, we can send them on as well.
If an institution has received approval of their HEERF 2 funds, meaning CRISA funds, and do they have to draw down any portion of those within the next 2 days during the application deadline?
No. And that is, I think some folks are getting wires crossed on 2 different 90-day requirements. And so on the one hand, with those institutions that we gave supplemental awards to, which were not any proprietary institutions because Congress created the new A4 program, those institutions, from the date of their supplemental award, are given 90 days for us to just see that they have some sort of activity, and then we'll reevaluate, right? We reserve the discretion after 90 days if they're not drawing down at least $1 on their funds, to think about what's going on there. But for 84425Q or A4 grantees, no, that's the 90-day requirement there is just to apply by this Thursday for the grant, and so they're not under the same. We're not under the same timeline.
All right, and I'm leading you there to another question that I've gotten a lot of times. That can we talk about the 50% drawdown threshold? A lot of institutions for their CRISA, the HEERF 2 funds, are getting letters that are talking about how and what procedures they're supposed to draw down these funds, and the 50% limit for the first period and so on. Can you talk a little bit about that? Because that's obviously a change from the HEERF 1 process to the HEERF 2 process as well, and it's causing yet again some confusion, and I want to make sure that we get it right.
Well, thanks for that, Tom. And I think, again, I think we'll be more formal about some of that in the future. But for now, an institution that, for instance, has determined all of its students that it will award emergency financial aid grants to, that comprises the entirety of its allocation, may appropriately draw down all at once that allocation, and may liquidate that expenditure. And in doing so, that may within our system set off an email that they received, but I believe that email instructs them to reach out to the program officer, and we encourage them to do so. But just to clarify that, as long as following cash management policies, that it has actually bills to pay in the sense that it needs to obligate those or cut those checks for those students, right? That there's nothing wrong with that being done all in one fell swoop.
Thank you. This was to the earlier question, and they made it much more succinct, and I think that this is much, I think that hopefully you can respond. If the HEERF expense is disallowed for some reason in the audit, so again, you've expended all your HEERF institutional funds in your audit, can you substitute other allowable expenses that were not initially paid with HEERF funding? So let's say, for the sake of argument, in the course of the audit, you had an expenditure that the auditors don't believe was within the parameters provided in the guardrails that are provided. but you certainly have other expenses that you also took care of. Can you change out one for the other if one is determined to be unacceptable and another is considered to be acceptable? Am I making sense there? I can see what the institution's trying to suggest. Can you? Uh-oh, this one might be a stump the department question.
Yeah, I understand, but your auditor has to have something to go to, and I'm not sure that it's appropriate for you to just keep feeding them a different thing to look at. I would suggest that they, apply the most conservative cost first. That would be my suggestion.
And we have Amy, and again, I think that there's some of this is going to be a matter of discussions. I hope you would agree, even between the auditors and the institutions, based on interpretations. So there is going to be, I think, some discussion that is going to go on here. And I think that's what they're looking for, is how do we address some of those circumstances as this process unfolds, if I'm taking a liberty of what I think this person's asking.
And Tom, I defer to Mark and Amy, but at least from my standpoint, there is no such thing as backup allowable costs. That if something is disallowed, they can go to their second tier or third tier that would then cover it. I don't know if that's what they were kind of getting at.
Okay. If the HEERF audit period schools fiscal year 2020 or calendar year 2020, I'm sure this was covered, but I missed it. So again, is the audit period fiscal year or calendar year? It's the institution's fiscal years that are used for the purposes of this. Can we use leftover institutional HEERF funds to cover the costs of HEERF stump audits due by 7/29?
We had this question already, that institutional funds can be used to pay the reasonable share or cost of the audit. Yes.
Yes, just reaffirming again, because that one's come up multiple times.
Yep. Just wanted to make sure.
Sorry to be redundant, but again, we want to make sure that I'm trying to be true to the people that are asking questions. I understand funds can be used for non-Title IV programs. If we offer a program that is not yet Title IV approved, for institutional or other programs that are accredited, can those funds be used for students in this non-approved program? I believe the answer is yes, Soren, correct? And Amy? It's a non-Title IV eligible program, but it's working its way towards approval. And for the Carissa Act funds, you are allowed to utilize it for non-Title IV programs, students enrolled in non-Title IV programs.
Yes, that is correct. I would encourage, lawyerly disclaimer, to look at our updated A4 FAQs from
A4, yeah.
January and updated in March, that I think speak to some of those parameters and all for students.
Yes, and we're actually coming up on time, and we only have one or two more questions, so I beg your indulgence very briefly. We stopped payment on uncashed checks to students. We then cashed out the grant to each student. Can the stop check fee be institutional or be used for institutional funds? In other words, as they were backing out the institutional checks, can they use the institutional portion of their COVID funds to pay for the cost that was incurred for the stop check fee?
I defer to Soren. Or it might be something we have to get back on.
Yeah,
that might be one you need to take internal.
Yeah, if you could grab that question for us, I'd love to take a little closer look at it.
And I'll let this be the last one before once again thanking all of you. Should amounts expended reported on the audit match the amounts reported on the quarterly reports? Some schools may have identified additional qualifying expenses during the fiscal year that were not reported, but may be included in the amounts expended on the audit report. Want me to try that one more time?
No, I got it, I think.
Okay.
But they may not match exactly, especially lost revenue. I had mentioned that the department allows, let's see, their direction is that they charge lost revenue on or after the last day of the estimation period. So if they charge it on the last day of their estimation period, but the flexibility hadn't been granted yet, then that would be a difference in what is reported on quarterly and annual versus what's included as an expenditure in the audit.
And with that, I will close by, go ahead, Soren.
Oh, no, and I was just going to say that the quarterly report, particularly the institutional quarterly report, we have an update. There are some instructions about updating it if you want to go through it and update it to reflect those different new expenditures.
Let me close by saying once again, Mark, Amy, Soren, as well as Karen Epps and others from the department that are on the call with us, and certainly Dr. Cooper, we very, very much appreciate all of you participating today. I may try and coerce some of you to come back on board, maybe for a follow-up webinar on procurement, specifically, especially with the UG regulations and the like, because I think that that's one of those things where we're going to need some additional guidance. We'll see whether or not you can. But sincerely, thank you for your time today. For our audience, a couple of things, just quick reminders. We do have our May 18th and through 20th higher education policy meeting taking place here in Washington. It's a busy week. The House just announced that next Tuesday there will be a discussion on institutions that attempt to go from for-profit to nonprofit status. So there'll be a hearing on that next week. Even as we've been having this webinar, the Senate Banking Committee is having a discussion on student loans and specifically on issues related to the imbalance, the equitable imbalance on student loans that CSPEN will be reporting on our Thursday call. And next Tuesday, we have a 90-10 best practices webinar that we'll be providing along with Aaron Lacey from Thompson Coburn. So busy times ahead, including, again, a Senate hearing for James Cavall, who is going through his Senate confirmation process on Thursday. So lots to continue to share from our CSPEN through our CSPEN Tom Bombs, but today was a very informative, and I hope you will agree, very helpful compliance-related webinar on the new HEERF audit guide. Mark, Amy, Soren, Dr. Cooper, and all the rest of the department officials and others on the call, thank you for today's webinar. We learned a lot. And I'm sure we'll have more questions, but you certainly helped walk us through a lot today, and we're very appreciative of your time and your efforts. Thank you very, very much.
No problem. Thank you. Take it easy.